Welcome to the podcast today on icebergs for financial analysis. I'm Danielle Goodrick and joining me today is Colin Linton. Hi Colin.
Hi Danielle.
Great to have you join us again today. To give you some background to Colin, he's been CIPS qualified for 25 years and a fellow for 10 years, so has a wealth of experience to share today. His 30-year commercial career has spanned across procurement, finance, sales and marketing, and he then moved into training, consultancy and the academic world a number of years ago. Colin's been involved with CIPS qualifications for many years, so some of you may know him, and also involved with a number of other universities and awarding bodies. And for the last 3 years, he's been involved in research into a number of different areas on contract management and skills for contract managers. If you listen to the last podcast Colin and I did on contract leadership, we talked about the skills for contract managers and the need for contract managers to have sound financial analysis skills. And he will now take you through some slides for a few minutes on his icebergs model. Please just note his icebergs model that will be shared today is under formal copyright protection with a registered trademark, and you would need to seek permission directly from Colin should you wish to use this for any purpose. So Colin, if I now hand over to you to run through the slides and then we can have a discussion at the end.
Great, thank you very much Danielle. And the first thing to say at the outset is I do have a background in finance, and I know that numbers are a strength of mine. I also know that it's not the same for everybody else. And what we need to understand is not about good, bad, being clever or not. We all have different skills, so we're all good at something. I happen to be good at numbers and financial analysis, and there are certainly things where I would need to develop skills further. So if, as you're watching this, in particular if you're watching this for self-development, you won't be alone in thinking that your financial analysis skills are not as strong as perhaps you think that they should be. What we do know is that financial analysis skills are really important. And here we have a list of the top 10, which is based on my own research. I've been undertaking research that Danielle mentioned for the last 3 years now. So I've collected data from experienced contract managers and senior procurement professionals to get a better understanding from them of the top skills that are required for contract management staff. And in the most recent wave, which was pre-COVID, so I will be gathering more data over the course of the next couple of months. But pre-COVID, so this data would have been collected in 2019, we can see that knowledge and understanding of financial analysis is ranked number 5. So it is a skill that's recognised as being important, particularly for contract managers and probably for anybody in a procurement and supply role. So if you do recognise this as an area for development, then it's certainly something worth focusing on. So why is that? Well, one of the things that we need to understand is that we must interact with internal stakeholders using their language and not ours. And very often finance is the language of the boardroom. So we need to understand the financial implications of everything that we do so that we can communicate more effectively with our internal stakeholders. Importantly, it's also a really key area of risk management. So for us, for example, to be able to spot early warning signals of potential supplier issues, this will really help us in terms of proactive contract management. Importantly too, it will help to support negotiations that we have with suppliers, maybe to help us understand what their costs are, to understand the differences between their direct and indirect costs, to understand what their profit margins are, and things like that. So generally, really, financial analysis skills for contract managers, for procurement professionals, is really all about credibility. Because certainly based on my personal experience, there is an assumption that somebody working in procurement will actually know the numbers. It definitely can be daunting, particularly for those who are not confident with numbers. As I said at the outset, we are all different. A lot of people simply lack confidence, I see this often when I'm running training workshops on finance, that people very often say right at the very beginning when we're doing the round of introductions that they've never been very good at numbers, they don't understand numbers, and often this dates back to childhood, when they were at school. My suggestion to people always is, keep calm, think logically, don't panic, take your time. And I think for most people, they're surprised actually by how much they do know, and certainly how much they can learn. So it is an issue of being confident, but if we can take a bit more time and think logically and understand what it is that we're looking for, it will just help to build some confidence. Of course, credit reports will help. And for many of you listening, I guess you will have access to credit reports. But they don't give us the answers. They will give us some calculations. They will show us some of the ratios, but they don't give the answer. So understanding what data is involved in creating the ratios, so what the underlying numbers are, is really, really important. So it's not just a case of taking things at face value. So I've mentioned this term financial ratios a few times. I don't know whether it's a good thing or a bad thing, but there are hundreds of them. You can just see a glimpse of my bookcase behind me over my shoulder. I've got finance books there that are full of hundreds and hundreds and hundreds of financial ratios. In itself, that makes life, in terms of interpreting financial statements in particular, very daunting, because no one wants to learn hundreds of financial ratios. But the good news is that you don't need to know them all. Now, we're looking at this from the context of somebody involved in procurement and supply, primarily using these as part of contract management so that we can be proactive and spot early warning signals. So rather than hundreds of financial ratios, we're not looking at this from the perspective of someone lending money or as an investment. We're looking at this from contract management risk. So there's probably only around a dozen or so key financial ratios that we need to focus on. Okay, so you don't need to know them all. What do we need? Well, the start point is that we need to have access to suppliers' financial statements, which is easy because they're public documents. Sometimes we might have a credit report too. So if we can access both, then we're probably in the perfect scenario. So when we talk about suppliers' financial statements, what do we actually mean? Well, we're talking about their balance sheet and we're talking about their income statement, which is also known as the profit and loss account. So armed with these two statements, we're able to then set about identifying the key information, the key data, and then we can calculate the ratios, which will help us undertake our risk assessment. Ideally, if we can, we'd like to have at least 2 or 3 years of financial statements, more if possible. Why do we need this? Well, we can calculate one ratio based on 1 year's financial statements, but it's much more meaningful for us to be able to then compare that with the previous year, the year before that, and so on. It will be interesting to see, obviously we're going through a period of significant economic problems for many, many companies. So it will be interesting to see the impact that COVID will have on financial ratios. So this is something that you won't pick up in your credit report. What you will pick up in the credit report is a ratio and the changes in ratios, but there will be no context. So we need to think more than just the numbers. We need to understand what the business context is. If possible, if you're able to get hold of an industry or a sector report for the suppliers industry or sector, then this is also very useful. These set out general typical ratios that we would expect in the industry or sector. And again, this is useful for benchmarking. Something we do need to bear in mind is that Our typical ratios for benchmarking will not only change due to industry sector differences, but also the size of the organisation. Maybe a new organisation we would expect to be more highly geared, and I'll talk about gearing in a moment, than businesses that have been around for a long time. Okay, so it's not just the case that we can compare directly businesses in the same industry or sector and assume that the ratios should be the same. Okay, the nature of their business models may very well be different. For example, one may be an online business, the other one might have infrastructure to support. This is the point I made earlier. It's more than just about the numbers. We need to understand what the business model is. Once we've got access to the statements themselves, we do need to understand what information and ratios are important to us. And equally importantly, we need to understand how we can interpret the information and the ratios. I often refer to the so what test. Okay, so we look at a ratio and it tells us that the gearing ratio has deteriorated from 50 to 60%. Well, so what? What does that actually mean? So which information and which ratios? Weird that though it may sound, think icebergs. The reason why I suggest we think icebergs, it's twofold. First is that when we see an iceberg in the ocean, in the sea, we just see the tip. And if somebody gives you a credit report, or when you're looking at the actual underlying financial statements, all we're seeing is the tip. It's useful, of course. It's useful to see that tip of the iceberg because it's a warning signal of what does lie beneath. And it's exactly the same with financial statements, with financial information. Now, it's useful to have the tip of the iceberg to see what's on the surface. What's really important, and I guess what really sets out people who have a high level of financial analysis skills, is to be able to dig deeper to see what lies beneath. So what lies beneath these credit reports? What's the lurking information that's given us these early warning signals so we can take action? And the other reason why icebergs is useful is because it's a mnemonic. And we need to have something that helps us to clear the mist of this plethora of financial data and financial information. I've already mentioned we're not looking at this from the perspective of a bank lending money or an investor checking to see whether the company's worth investing in. We're looking at this from a procurement and supply perspective and looking at contract management risk. So to help us do this, there will be various things that we're not interested in or less interested in, but we should be focusing on interest, costs, efficiency, borrowings, earnings, revenue, gearing, and solvency. So hence, think icebergs. And this now gives us a structure to look at the data which is the most relevant to us. And just very quickly, I'll go down each just to give some tips and some suggestions on the kind of things that we should be looking at. So interest. You will find the interest payable in the income statement, and we're interested in understanding how much interest is a supplier having to pay on its debts. Okay, so interest payable relates to its borrowings, and we're looking at this in relation. So the really important thing to understand with ratios is that it connects different pieces of information together. So rather than look at the interest in the income statement and try to understand whether this is high or low, we can't answer that question. People often ask me these things when I'm training and say, so Colin, this company is paying $150,000 interest, is that high? Well, we can't answer that question, and that's why we have ratios, because it enables us to make a connection and then we can start to decide whether it's high or low. So we should be looking at the ratio which is called interest cover, and this means that we're checking out the interest payable in relation to the organization's earnings or profits. The higher the cover, the better. And this means that the business is able to withstand shocks, to borrow more money, and when interest rates start to go up, it's got this buffer. Okay, so the higher the interest cover, the better. Costs. Again, we will find details of the costs in terms of direct and indirect costs in the income statement, and this will give us an indication of how well the business is being run in terms of cost management. Okay, we'd be expecting to see costs managed in relation to revenues. So if revenues are going up, then fair enough, we'd expect to see costs increasing too. But we'd be checking the gross and net profit margins to make sure that costs are not uncontrolled. Okay, so the profit margins will look at the costs in relation to revenues. Efficiency. This is really important. This tells us, this shows us how effective the business is at managing its own working capital. It's much cheaper, much more effective for businesses to use their own resources, their own what's called current assets, to fund the business rather than having to go outside and borrow money from a bank. Because if they borrow money from a bank, that's debt, it has to be repaid, and there's also a commitment to pay interest. So what we should be looking at here in terms of efficiency is we should be checking how it manages inventories, its receivables, and its payables. So these are the core elements of working capital. And ratios that we can use here would be inventory, receivables, payables. The terminology is interchangeable here, so you might see inventory called stock and our receivables and payables, debtors and creditors. But we can calculate the days turnover, if you like, of stock, debtors and creditors to see how effectively managed the working capital is. Borrowings, well, I've already mentioned this several times. It's really important that we understand the levels of debt that a business has. Debt isn't a bad thing, okay? Debt's fine, as long as it's affordable. So we're looking at how much debt the business has, both short-term and long-term. And importantly, when we're undertaking comparisons year on year, we're checking to see whether short-term and long-term debt has increased or not. If it has increased, then we should be looking in the balance sheet to see how that money has been used within the business. So, for example, we might see that debt has increased, but so have assets. So that signifies at least they're borrowing money to invest back in the business by buying new assets. Where we can't see corresponding assets, then we need to dig more deeply to understand, so just what is it that they're doing with the money that's being borrowed. Earnings. It's another interchangeable term, so this relates to profit. It's definitely true that you can't pay the bills with profit, and profitable businesses do actually go bust. So it's an important thing. It's a frequent misconception that people see profitable businesses and think, well, this is great. They're bound to survive. It is a good thing. Okay, so I'm not suggesting that profit isn't good, and in fact, loss-making businesses are not sustainable. Okay, so it's not a sustainable model over time, but profit is not the be-all and end-all. You need cash to be able to pay the bills. Profitable businesses do go bust. Okay, insolvency is the key thing that we're looking for. And right at the beginning, I said, talking about the language of the accountants, the language of the boardroom, EBITDA. This is a commonly used term to define a measure of what most people would regard as the actual true profit from operations. It stands for earnings before interest, tax, depreciation, and amortization. EBITDA is no language. It's an acronym, but it's also a word of the boardroom. And the crucial thing for anybody in any business function, particularly now, because so many organizations are under so much financial pressure, you really need to be able to understand how you, in what you're doing every day, contributes to an improvement in EBITDA for your organization. So from a procurement perspective, you need to understand how you're contributing to EBITDA. This, of course, relates to commercial organisations which are driven by profit. Revenues. Revenues are the lifeblood of the organisation. Without revenues, then there will be no income, no cash inflows coming into the organisation from which it can meet its obligations. So really the rule of thumb here is look out for the top line of the revenue to see if revenues are growing. Will be a challenge for organisations. So I guess we need to redefine the boundaries on this due to COVID, but we'd certainly expect to see any changes year on year in revenue to be in line with the market, to be in line with its sector. Gearing. I'm not sure if it's possible to have a favourite financial ratio, but if it was, it would be mine. Arguably one of the most important. Gearing shows us how a business is being funded. There's two core methods of funding a business. There's debt, which is money that's borrowed, and there's equity, which is shareholders' money, which generally speaking is permanent. And I would just say here that there are different methods used of calculating gearing. Okay, so don't be confused if you do some of your own research and you find different definitions. So the definitions I've got here are the most commonly used. And so certainly for gearing, most commonly you would find the ratio focus on long-term funding. And this is a comparison, a ratio of long-term debt, which is money that's borrowed from third parties, typically banks, versus equity. Okay, so it's a ratio that looks at the long-term position. Why is this so important? Well, if the gearing is high, we know that if this business experiences trading issues, it will still have a commitment to make repayments on the debt and to cover interest. Okay, so the higher the gearing, the more susceptible this business will be, particularly if it encounters more challenging times, and also when interest rates increase. High gearing isn't necessarily a major issue as long as the debt's affordable. So this is where it's useful to look at combinations of financial ratios. So for example, if the gearing ratio is high, but the interest cover is also good, then we'd be a bit more relaxed. And it also relates to the final one, which is solvency. It's solvency or insolvency, it really is the main trigger for businesses to go bust. So the key here is, can the business afford to meet its short-term obligations, so its short-term current liabilities as they fall due? So does it have access to liquidity, especially if it's being squeezed by its creditors? So if it has high gearing and the banks are saying enough is enough, and it also is being squeezed by its creditors, then its chances of survival will be slim. So in terms of solvency, we're looking at the relationship between its current assets and current liabilities. Okay, this is known as the current ratio. You can also calculate something which is called the acid test ratio, which is the more cautious current ratio. So basically it looks at the current assets but deducts inventories, because very often inventories, once they've been taken into stock, have a very low value, maybe scrap value, maybe even no value. And this really is a summary. I could spend a whole day, well I do spend a whole day talking about this type of thing, but just very briefly to run down and to put this icebergs into context of the specific ratios that we need to look at. So interest, we're talking about interest cover. It's the interest cover ratio. When we're talking about costs, we're really interested in cost management, and we're looking at costs in relation to revenue. So we're looking at a whole range of different profit margins, whether it be the gross or net profit margin or the EBITDA margin. Efficiency is all about working capital. So this is about our stock inventory turnover days, our receivables debtors days, and our payables and creditors days. Borrowings is really just all about looking at how much short-term debt, long-term debt has gone up by or has been reduced. And if it has gone up, what has a company used that money for? Earnings. So this is all about profit. So this is about understanding how much profit is making, and there are various definitions and different types of profit. So we'd be looking at net profit, gross profit, and our EBITDA margin relative to revenues. So a slightly different perspective really to cost. With costs, we're really looking at the actual cost to make sure they're managing them and costs are not changing too significantly, particularly increasing. Earnings is all about how much profit, how much earnings it's making from its revenues. Revenue, we're looking at ideally year-on-year growth. Due to COVID, maybe that's a fantasy land at the moment, but of course where we're looking at a year-on-year decline, we would expect that to be in relation to the market, in relation to other similar organizations. And really the final two are really important in terms of will the business survive. Gearing is looking at long-term debt to equity. Solvency is looking at short-term. Anything that you see in financial statements which is called current means it's short-term. We'd expect it to change certainly within 12 months. Anything that's described as non-current is longer term. I'm conscious of time, Danielle, and I am conscious that very often I do talk about these things for a day. So I think it's probably a good spot for me to stop and hand back to you for any questions. I know you do have a few questions.
We'll have lots of questions for you. Thank you so much. You covered such a broad array of things there, but I think really great, and I think some of the things you touched on were really interesting. So I have got a few questions for you, if that's okay. So early on you mentioned about credit reports. So how important are these for, or how helpful are these to contract managers, would you say?
Yeah, they are very helpful. I don't know whether I should admit this, Daniel, but I'm pretty certain I predate credit reports. I come from an era when we would gather financial statements in paper form, and it would be an activity to sit down with the company's financial statements and write down and calculate the ratios ourselves, which from a learning perspective, of course, is really useful because we can understand what the changes in the underlying information actually mean. So we can understand how ratios change. Now, life has moved on, and credit reports are really useful. They are generally correct, but they are dependent on picking up their feeds from other third parties. So there is a very slight risk that they might have picked up an incorrect line of data. So if you do see something and a financial ratio has suddenly changed beyond recognition, it might actually be the credit report that's wrong. It is unusual. So it's good for kind of surface information. It's useful for those people that have relatively low level of experience in terms of financial analysis. But there's no substitute really for knowing the substance that underpins it. But they definitely help, and they're useful as an indicator, and certainly something maybe if people work in an organisation where another part of the business gathers in this financial data, maybe it's something that could be set up that where there's a change in a financial ratio beyond certain tolerances, then maybe procurement could be advised automatically. So they are a good thing.
A good indicator. Okay.
Yeah, a good indicator.
So you mentioned the importance of the gearing ratio and looking at the so what. So would you say that this is the most important measure for contract managers to focus on?
Yeah, it's certainly an indicator. People often ask me when I'm training, and even after training, I get people who've got my email, or if they don't have my email, they've got my LinkedIn, or they look me up on LinkedIn and send me a message. And the message often is that we're looking at a situation and the gearing ratio is 80% or more, which is high, and often much higher in the hundreds of percents. So does this mean that the company's about to go bust? Does this mean that we shouldn't be using them? And the reality is, it's like us as individuals, as consumers. Many consumers, particularly over the last 12, 15 years with interest rates so low, have very, very high gearing. We've got very high mortgage, high level of personal loans, high level of credit card debt. But as long as you've got revenues coming in that you can make the repayments and to meet the interest repayments, then high debt isn't a problem. High debt becomes a problem when it becomes unaffordable. So gearing will give us that kind of hint. So which companies are able to withstand shocks? So we've got the lessons here with COVID, where we realized fairly quickly that a lot of our retail outlets, a lot of businesses, only had enough cash to be able to close down for 1 month. Some businesses couldn't afford to close down at all because they've got high debts. So, which businesses are more likely to be able to survive for a longer period of time? Well, in the extreme, if you've got a business that doesn't borrow any money, then of course they're in a very positive, powerful, positive position. Whereas the higher the gearing, I tend to look at these in clusters, and certainly gearing is really important. But so too would be the solvency ratios. So gearing shows us the long-term position. Our current ratio gives us the short-term position. So if we've got high gearing and our current assets are 10 times higher than our current liabilities, which is a good thing, then I'm more relaxed about the fact that we've got 500% gearing. And if our interest cover is 20 times, then really I'm very relaxed. Plus, I need to understand what the nature of the business is. Is it a type of business where actually when we see the financial statements this time next year, a disaster would have struck because all of a sudden they haven't generated the revenues and cash flow to be able to make those payments. They haven't generated the profit. So it's about being able to think through about what's happening in the real world and think through what the impact would be on the business.
I think that's important, and it'll be interesting to see what obviously comes out, develops on the back of COVID, and what shapes over the next year. I think grouping those ratios together, like you said, is really important to look at the whole picture and not just in isolation.
Yeah.
So we've obviously talked about financial analysis skills for contract managers and them being important. So if we look at, say, the demise of Carillion, for example, what could have helped to identify this? And do you think that this is within the contract manager's role to identify that?
Well, let's take the second element first, Danielle. One of the things that I always tell people when I'm delivering contract management training is it's really important for a contract manager to understand where they fit within the procurement cycle. So as a contract manager, one of the first things that I would be doing is checking my understanding of what is it that the organization, what my boss expects me to do. Worst case scenario is I assume that someone else is checking the credit reports and everyone else thinks, well, Colin's a contract manager, he's going to be doing that. And the worst happens and no one has been doing it. So I think to answer the second part, it's really incumbent upon us as professionals to make sure that we understand what it is that's our responsibility. And personally, I would always make that assumption, particularly if I'm the nominated. So if you're working somewhere where there's a contract database and it has a field that says contract owner or sponsor or contract manager, and my name is on one of those, then I'm at least going to make sure that someone else is checking the financial elements of that. And of course, there are other things around. We need to understand what the significance of that contract is, because of course not all contracts are as important as others. Now, Carillion is a workshop on its own, Danielle. So I'll keep this to a very brief sort of, I was going to say 1 minute, I can't do 1 minute, but 2 or 3 minute summary. Of course, we have the benefit of hindsight with Carillion, and hindsight is a wonderful thing. But don't think you'd find anyone that was involved in procurement that understands anything about Carillion that would have been surprised on the 15th of January 2018 when Carillion went under. They had three profit forecasts, warnings that were announced. So a profit warning in itself doesn't mean it's the end of the business, but there were three starting in July the previous year. The chief executive left the organisation. So it's certainly it's triggering alarm bells in our thinking when in July, when you've got a profit warning and the chief executive leaves. If we think about Carillion, so it's not just about the numbers, if we think about their business model, so this is what you don't get in a credit report. So this is what effective contract management is really about in terms of being proactive if we've got a contractor, a supplier organisation, a contract, which is really important to us. Now we need to understand the changes in the business model. And Carillion, it effectively went from being a large construction company, which it still did, but moved into the world of facilities management, which is very different. And some of the projects and the contracts it was bidding for were very different to provide services in the public sector. It was having to bid competitively, so its profit margins were being squeezed. And of course, these were areas where Carillion had lower levels of expertise because it was a big construction company. And so it was dependent on the supply chain, dependent on subcontractors. So once we start picking up these early warning signals of profit warnings and the fact that the chief executive has left the organisation and thinking about the changes in its business models, then certainly we'd be looking at alarm bells. Carillion, why did Carillion go bust? Well, it didn't have enough cash. It was profitable. The final or the last year's financial statements, interestingly, it was showing a profit. So it goes to show profitable businesses can go bust. It went bust because it didn't have enough cash. It actually had high, what on the face of it appeared to be high revenues. So this validates the rationale for looking at ratios where we link these different numbers together. So it had in excess of 5 billion, I think, revenues, high, hadn't been growing too significantly, but 5 billion revenues sounds, it's great, isn't it? And it was profitable. But it's always difficult for these big companies to unscramble precisely what the actual operating profit is, but broadly around 100 million. So it's 100 million profit on 5 billion revenue. So, I set people the task of, while they're watching this, to get the calculator out and to calculate the profit, the actual profit margin, the percentage margin of 100 million relative to 5 billion. It's peanut, it's tiny. And so with such a small profit margin, there's no buffer there. Carillion had approximately £1.5 billion worth of debts that had been increasing, also had a pension fund black hole, also experienced major issues on some really significant, so this was in the public domain, some significant contracts. And of course, it didn't have any buffer to increase costs, supply chain, carry the burden of supply chain costs. It was also common knowledge in the market that Carillion was notoriously becoming later and later and later and later in paying the supply chain, which obviously means that it had cash flow problems. And they suffered some bad debt, certainly one very high profile bad debt in the Middle East, and I believe there was also one in North America. So this was money that they were expecting to come in that didn't come in. So they've got high gearing, very low interest cover, they've got declining revenues, very high debts, tiny profit margin. They're not able to withstand these shocks. They're under pressure because they've got this massive pension fund black hole where they need to find money from, which is effectively more debt. So it was a ticking time bomb. Most people would say it was inevitable. But of course, hindsight is a wonderful thing. And ultimately, they went under because the banks refused to extend the credit. But it's a great example, and it does validate, the usefulness of looking at this data. But I would put a caveat with this, that it's useful to think about the business itself and the business context and the business model.
No, good points there. And I think it's always easier in hindsight to look back, isn't it, and make judgment. So if we look at obviously the slide you've left on screen, then you've covered quite a few ratios there that are important for contract managers to look at. Which would you say would be the most important to start with? And could you give some examples, say, of where changes might highlight some risk factors to consider? I think that would be really useful to bring this to life a little bit.
Yeah, certainly interest cover.
Okay.
There's a whole generation of us, and certainly my children would fall into that, of where they don't really have much understanding of interest rate risk. They're in their early 30s now, and during their years of borrowing money, interest rates have been really low.
Yeah.
I'm obviously older, and I come from a generation when I can reflect back when interest rates, bank base rate was significantly higher. I can recollect a time when actual bank lending rates, so including the margin, were around 20% per annum. Imagine having a mortgage and having to pay 20% interest per annum. And so, these things, hopefully those days won't return, but that's why understanding whether there is some kind of buffer is really useful. And the smaller, and my guess is due to COVID, we will see that buffer reduce. So some businesses might have had interest cover of 5, 6, 7, 10, even higher. But because profitability will be squeezed and their debts would have increased, then that buffer will reduce. And of course, once that buffer has gone and they're unable to meet their interest obligations, what happens then? Where do they go to next? They might be able to refinance and go to venture capitalists or other investors, and that would be their solution. So how do you change your gearing ratio? Because there is a connection between interest and gearing. Well, we can improve the gearing ratio. We can reduce the debt relative by trying to get more investment in. Well, that's easy if you're a successful business, but if you're running an airline at the moment, then that might not be very easy to convince shareholders to place their money into a risk venture in the promise that they might achieve a dividend at some stage in the future. So certainly gearing, as you can tell, I'm a fan of understanding gearing. And of really understanding the significance. And I think sometimes a way to look at this is just so if we, let's try and flip things over, and if we were running that business, what might we be able to do? And this is really the kind of test of whether we understand these ratios. So what is it that a company would need to do to improve its gearing ratio? Well, it needs to do something to reduce its level of debt, or to improve its equity. The efficiency ratios are useful because the more efficient the business is at running its own working capital, the less dependent it will be on going outside to borrow money in. And certainly in my experience, it's an area where either if I'm running skills training or if it's qualifications training, so if I'm teaching, calculating these days, students often understand how to do the calculation but really have no idea what it means. Now, if we're looking at financial statements and we can see that the company has an overdraft, if they're able to more effectively manage their working capital, they could actually reduce their need for the overdraft. So if they could gather in payments from their receivables, if they could be better at managing that, or maybe even finance them using invoice finance or factoring. So I think sometimes with this, it is about the so what, and thinking about, so why is it that some businesses have got a better, more favorable ratio than others? What is it that they're doing? So certainly the efficiency ratios and understanding what these days turnover. So if we've got a business that's got stock that's just sat there, that's a cost for the business. The more efficient we can be to increase the speed of throughput. Or, of course, the other extreme, we flip that on its head, is maybe working to more just in time to reduce or eliminate inventory altogether. Of course, we've learned through COVID that's high risk. So, just in time often means just too late or just run out. So if we operate to a just-in-time model, it could be very efficient in terms of managing working capital, but it could be disastrous for the business if we haven't got any. And really the last one is certainly something to focus on, because why do companies go bust? They go bust because they're insolvent. It's the same with all of us. We could have a portfolio of assets, but if we've got to pay the bills, when it comes to the time in the month to make the mortgage repayment, which is actually mine today, I think it's the 18th of the month, my mortgage is due today. Now I need to make sure that I've got liquid funds, I've got either cash that's there or an agreed borrowing for that money to go out. And I think sometimes people tend not to be able to relate it to things that they understand. What we're talking about here, in some respects, isn't significantly different to us as consumers. And I guess really just to wrap up, based on your question, Danielle, it demonstrates the point. It's not really just about one of these. The balance sheet and the income statement are not separate documents. They work together. We need to be able to see how inventory, which is stated in the balance sheet, relates to our income statement, relates to our cost of sales, the things that we've been buying. We need to understand how the revenues, which will be stated in the income statement, relate to our receivables, our debtors, which are shown in the balance sheet. So they're intrinsically linked.
I think what you talked about there, the so what, is so important as we enter this recovery phase in a post-COVID world, because it's going to be even more important to pay close attention to your suppliers in terms of how they're recovering and their cash flow, like you say. So great. Thank you, Colin. Really, really, really great. So just to think about that then, in terms of a recovery phase and things like that, you've mentioned finance is a language of the boardroom, for example. So procurement are obviously talking about a lot that they're not getting a seat at the table. Is this a way for procurement to finally get their seat? Understanding this in depth and helping the organisation as they enter a critical point in their kind of organisation's cycle coming out of COVID.
Yeah, it's certainly, I would suggest it's certainly an area where we can gain more credibility. There's lots of really interesting debate, discussion on LinkedIn, about ideas that people are coming up with. And I have to say, for the most part, they're really good. They're really enlightening. People are thinking about being innovative. For me, I think we just have to have a real take a step back for a few seconds, and let's just have a dose of realism. Now, for many businesses, they don't have time to spend months and months and months and maybe a year developing a new strategy. I'm not suggesting it's unimportant, but we're talking, for many businesses, it is about survival. So we have to demonstrate as professionals, and it's not just procurement, it's every single function. Okay, to be credible, everyone working in a commercial organization, and not just profit making, any organization, need to understand, to recognize the pressures that organizations are under, particularly commercial organizations which are profit making. Okay, we've got shareholders that need to be satisfied, and I think it's incumbent upon us as professionals in whatever functional area to understand what the key requirements and key drivers are. And it is an issue of credibility that the language in the boardroom for most businesses at the moment is financial survival. It's about financial health. We're contributing to the financial health. And I absolutely buy into CSR, the 3 pillars: profit, planet, people, and where we're looking at profit as just one element. But the reality is, if we can't achieve financial health, financial well-being, there will be no business. Okay, so that's why we look at these pillars, because they're all at least equally important. But fundamentally, at the moment, there is a global crisis, and we all need to contribute towards the financial health. And so I think as a profession, we need to demonstrate that we understand what the financial priorities are. And certainly EBITDA, there are other financial measures, and really what procurement professionals need to do is to understand what the key financial measures are of their organisation, to understand how they're contributing positively to that within the short term, as importantly as keeping our eye on the longer term strategy.
Yeah, and the value that they can add. So yeah, great to summarise, I think there, Colin. Thank you. So just to close then, what would be your top tips for someone looking to improve their financial analysis skills, and taking this forward and being able to show this value to their organisation?
Yeah, well, I guess as an academic and a trainer, I'm biased, so I'd automatically suggest investigating some training, and maybe through organisations like CIPS that run train across a whole range of different areas, and also academically, maybe seek out a qualification, and particularly for those who are not confident in finance, rather than seeking out a plan for training, a route for qualification, and avoiding that finance module, which I know people do. They look at different programs that are available and think, oh, I don't really want to do finance. So that's certainly something I'd think about. I guess the first step really is to take a step back, and based on what we've said here, how much of this makes sense? How much of this do the listeners feel confident with? Because there would be some people thinking, yeah, actually, yeah, I remember that. I did that in my CIPS studies some time ago, or other studies. And there'd be other people thinking, wow, I didn't really understand very much of that at all. There's always a need, and this is feedback that I often get when I'm training, where people come in, they're MCIPS qualified, or they've got a finance qualification, or studied a finance module. Feedback almost invariably at the end is, that was just a great refresher. I'd forgotten about that. I'd forgotten just how to use these in conjunction. So I guess it's the first step with training, understand your own training needs. And there's a tendency to select the things that we're already comfortable with. It's really, really interesting that I've been playing the guitar for many, many years, and I've decided to go through a more structured program of study, and I'm continually practicing the stuff that I like, that I'm really good at. And there are a couple of chords I just cannot do, but I very rarely do them because I struggle with them. So what I should be doing is, the next time I pick up my guitar, just practice and practice and practice and practice the things that I'm not very good at. And it is something where we do need a refresh. I do believe strongly that there is an expectation that when we're dealing with internal stakeholders and suppliers as well, to an extent, that there is an expectation that because we're procurement, that we do understand the financial aspects. So I think it's just a case of of being brave, push the boundaries, just dare to stick a toe in the water, and even if this podcast obviously will be a first step. I've already had some messages, Danielle, from people that have watched the others, and saying, because I've mentioned finance, and we mentioned financial analysis skills, so I've had some messages from people saying, could I recommend any readings or anything online? So of course I've recommended this as a start point. Yeah, as a next step.
I think in the current climate, like you said, it's so important to understand where your skill set lies in this and where there is room for development, or where you can stretch yourself, like you say, and get yourself out your comfort zone and see if you can add additional value. Or I don't know what your thoughts are, but perhaps working internally with key stakeholders like your finance team and working things through with them to understand it, because they are specialists in this area as you are in supply chain. So
Yeah.
it's worthwhile having those conversations and running it through and seeing what to look out for and where there's shared learnings there.
Yeah, I agree absolutely, and I think in the current climate, it's it's probably easier to do that. And I would like to think, certainly if somebody came to me and asked if I could explain something around the various functional areas that I'm involved in, then I'd be happy to do that. And I think it's a bit easier to do it and say, just drop somebody an email and say, have you got 15 minutes that we could just do a Zoom, or we could do a call? And it's not quite as sort of noticeable. It's not like we feel like we've got a sign on our head saying, oh, I don't understand financial ratios, so I'm going to stand by someone's desk, or we're going to sit in a room in the office. It's much more discreet now. And I'd like to think that someone could say to someone working in finance, have you got 10 minutes, 15 minutes just to explain this to me? So I think COVID, has been awful, but it's also represented an opportunity for people perhaps to spend a little bit more time undertaking self-analysis, and self-assessment, to understand where they're strong. And I agree. I think now's the time, push the boundaries. And I think for a lot of people, and there are a number who have gone through their working life and maybe even education with just thinking, I'm not a numbers person. Yeah, but no, push the boundaries, test yourself, and actually you might surprise yourself.
Good advice. Thank you. Thank you so much for today and the other podcasts. I think they've been really well received. Your level of insight has been great experience to share. So thank you so much again for doing this.
My pleasure, Danielle. Thank you for having me.
And look forward to seeing what the research comes out next year as well, and seeing what the changes are. That would be really interesting post-COVID.
Yeah.
Thank you to everyone for listening today. We hope you found it valuable. I'm sure you did. We are going to be pulling together some summary notes which we'll share on knowledge as well, with some of the ratios that Colin's talked about today for you to download. But if you'd like to listen to any of the other podcasts that we've got available, you can access these via cips.org/knowledge. Thank you.